You are one paycheck away from everything falling apart. Maybe you already know that feeling. The quiet anxiety that creeps in at 2 in the morning when the bills are stacking up. When you look at your bank account and feel that hollow sensation in your chest. You work hard, you show up every single day, and yet somehow at the end of the month there is just never enough left over to feel truly free. That is not a personal failure. That is a system designed to keep you exactly where you are. But here is what nobody told you. While you were trading hours for dollars, some people figured out a completely different game. A game where money works for them while they sleep, while they are on vacation, while they are watching their kids grow up. And the engine behind it is something called dividend investing. And before you click away thinking this is not for you, stay with me, because what you are about to learn in the next few minutes might be the most important financial shift you ever make. Let me paint you a picture of where most people are right now. You wake up Monday morning and the alarm goes off before sunrise. Your body is tired. Not just physically tired, but soul tired, the kind of exhausted that a weekend cannot fix. You commute, you grind, you give your best hours of your best years to someone else's dream. And at the end of the month, after taxes, after rent or mortgage, after groceries, after car payments, after all of it, what is left? Maybe a few $100s if you're lucky, and that money gets eaten up by something unexpected before you even decide what to do with it. That is the cost of inaction. And it is brutal, because every single month that passes without a plan is another month where the gap between where you are and where you want to be gets wider. Time is the one asset nobody can get back, and right now you are spending yours in a way that is not building anything permanent. Here is what dividend investing does differently. It builds a second income stream that does not require your time. A stream that pays you simply for owning shares in companies that distribute a portion of their profits directly to shareholders. Every quarter, sometimes every month, money lands in your account. Not because you worked a shift, not because you took a client call, because you made a smart decision and let compounding do its thing. Now here is something I need to share with you, and I want you to take this seriously. We have a program linked down below in the video description that goes far deeper than anything I can cover in this video. People who have gone through it have completely transformed the way they think about money and passive income. But here is the thing, it is not for everyone. And honestly, if you are the type of person who is just going to watch this and do nothing, then that program is probably not the right fit for you anyway. The people who benefit most are the ones who are truly ready to stop being spectators in their own financial lives. If that sounds like you, check the description when you are done. But let us keep going, because the information I am about to give you is powerful on its own. Dividend investing starts with a simple concept. You buy shares in companies that pay dividends. These companies, often large, established businesses that have been around for decades, distribute cash payments to their shareholders on a regular basis. The dividend yield tells you what percentage of the stock price you receive back annually as income. A 3% yield on $10,000 invested means $300 per year. A 5% yield means $500 per year. Now that might not sound life-changing yet, but stay with me because the math is about to get interesting. The real magic is reinvestment. When you take those dividend payments and automatically reinvest them to buy more shares, you start a process called compounding. Your shares earn dividends. Those dividends buy more shares. Those shares earn more dividends. Over time, the snowball grows not just in size but in speed. The longer it rolls, the faster it accelerates. This is why people who start earlier, even with smaller amounts, end up dramatically ahead of people who wait and invest larger sums later. Here is a real scenario to make this tangible. Imagine someone who starts with $5,000 in a dividend portfolio with an average yield of 4% and adds just $300 every single month. After 10 years, assuming modest stock appreciation alongside dividend reinvestment, that portfolio could grow to somewhere in the range of $70,000 to $80,000. And the annual dividend income at that point could be generating over $3,000 per year passively. At the end is a growing second income stream built from consistent smart behavior. Not luck, not timing the market, just strategy and discipline. But here is where the pain gets deeper for most people. They hear information like this, and they get excited for about 48 hours, and then life gets in the way. The problem is not knowledge. The problem is not even money. The problem is direction. Most people do not know which dividend stocks to choose. They do not know whether to prioritize yield over growth, or growth over yield. They do not know how to build a diversified portfolio that protects against downturns. They do not know how to avoid dividend traps, which are stocks with extremely high yields that are actually warning signs that something is wrong with the company. Without that framework, people make emotional decisions. They chase the highest yield, they panic during corrections, they sell at exactly the wrong moment, and they wipe out months or even years of progress in one bad week. Let me walk you through the core principles that separate people who actually build passive income from those who just talk about it. First, choose quality over greed. The best dividend investments are not the ones with the highest yields, they are the ones with a long history of not just paying dividends but growing them consistently every single year. These companies, often called dividend aristocrats, have proven through recessions, market crashes, pandemics, and economic chaos that they prioritize returning value to their shareholders. That kind of reliability is worth more than a flashy high yield that vanishes the moment the company hits trouble. Second, diversify across sectors. Do not put everything into one industry. If your entire portfolio is in energy companies and oil prices collapse, your income takes a devastating hit. Spread your holdings across sectors like consumer staples, healthcare, utilities, financials, and technology. Each sector responds differently to economic conditions, and together they create a more resilient income stream. Third, understand the payout ratio. This number tells you what percentage of a company's earnings it pays out as dividends. A company paying out 40 to 60% of earnings as dividends is in a healthy position. It is rewarding shareholders while keeping enough profit to reinvest in the business. A company paying out 90 or 100% of earnings as dividends is giving you a warning sign. That dividend is vulnerable. If earnings dip even slightly, the company may be forced to cut the dividend, and when that happens, the stock price often drops at the same time, hitting you twice. Fourth, think in time horizons, not price movements. The biggest mistake new dividend investors make is watching their stock prices daily and making emotional decisions based on short-term volatility. The stock price on any given Tuesday means very little if the company is still growing its earnings and paying and increasing its dividend. Dividend investing rewards patience in a way that almost no other investment strategy does. Your job is not to predict the market. Your job is to hold quality companies and collect your payments. Fifth, use tax-advantaged accounts wherever possible. Depending on where you live, dividend income inside certain retirement accounts can grow completely tax-free or tax-deferred. This dramatically accelerates your compounding by keeping more of your money working for you instead of going to the government. A dollar that compounds over 20 years inside a tax-advantaged account can be worth dramatically more than the same dollar compounding in a taxable account. Now let us talk about the shift that happens when this actually starts working. Because there is a moment, and every dividend investor who has stayed the course knows exactly what this moment feels like. You wake up one morning, you check your account, and you see that you received a dividend payment overnight. Money appeared in your account while you were sleeping. It is not a huge amount at first. Maybe it is $12, maybe it is $40. But that is not the point. The point is the feeling. Because in that moment, for the first time in your life, your money made money without you doing anything. And something shifts permanently in your mind about what is possible. That feeling starts small and it grows. As your portfolio grows, as the dividends grow, as reinvestment keeps stacking more shares, those quarterly or monthly payments get bigger. And one day you realize that your dividends are covering your Netflix subscription, then your phone bill, then your car payment, then your groceries. There is a cascading sense of freedom that builds layer by layer. And the most profound part is that this income does not depend on whether you are healthy enough to work, whether your employer decides to keep you, or whether the economy cooperates. It is yours. You built it. And it keeps showing up. The difference between where you are now and where you want to be is not talent. It is not luck. It is a framework, and it is starting before you feel fully ready, because nobody ever feels fully ready. If you have been watching this and something is stirring in you, if there is a part of you that is done with the cycle of working more to earn more without anything permanent to show for it, I need you to look at what we have linked in the description of this video. The program below is designed specifically for people who are serious about building real passive income through dividend investing with a clear, structured approach that removes all the guesswork. Most people will scroll past it. Most people will tell themselves they will get to it later, and later will become never, just like it always does. But you are still here. You watched this entire video. That tells me something about you. That tells me you are actually serious. The people who have gone through what is waiting in that description did not wait for the perfect moment. They made the moment perfect by deciding. Go check it out right now while this is still fresh and while it still means something to you. Because the cost of waiting is not staying the same. The cost of waiting is falling further behind every single day.